Here's something that sounds impossible. Two people retire in the same year. One earns $60,000 and pays federal income tax. The other earns $100,000 and pays zero. Same IRS, same tax code, same year. So how does that happen? If you're approaching or in retirement and you've assumed that higher income automatically means higher taxes, this changes how you think about retirement income. The tax code doesn't only care about how much you make, it cares about what kind of income it is. Stay with me to the end. I'm going to show you a simple order of operations you can apply once a year that keeps more of your money working for you. The IRS taxes income in layers, what I call income stacking. Picture your tax return as a stack of blocks. At the base is ordinary income, so W-2 wages, IRA and 401k withdrawals, interest, and non-qualified dividends. That fills the tax brackets first. Long-term capital gains and qualified dividends stack on top and can receive a 0% rate when the base of the stack stays low enough. Now, two retirees, person A earns $60,000 mostly from IRA withdrawals, and person B earns $100,000 mostly from long-term capital gains in a brokerage account. Same filing status, same standard deduction, same year. Person A's income is almost entirely ordinary income. After the standard deduction, what's left is taxed at the lower brackets. No special 0% treatment applies to that base. The result is real federal tax owed. Person B looks richer on paper, and the makeup of income changes everything. Deductions reduce ordinary income first. Once ordinary income is cleared, what remains is mostly long-term capital gains. Those gains can fall inside the 0% long-term capital gains bracket. So the federal income tax bill lands at $0. Here's a quick example to make it click. Assume married filing jointly in a recent year, standard deduction, no ordinary income after deductions, and $100,000 of long-term capital gains. The standard deduction reduces taxable income. The remaining gains sit within the 0% bracket for that filing status. So federal income tax, $0. If you file single or use different numbers, the idea is the same. The thresholds shift, the order stays the same. Here's what most people miss. The tax code doesn't punish income, it punishes ordinary income. This isn't a trick, it isn't aggressive, and it's legal by design. The code taxes different types of income at different rates in a set order. Understand the order and you start shaping which dollars show up where. So let me ground this with a quick story. A couple in their early 60s sat across from me. They saved consistently and kept expenses reasonable. On paper, they could support their lifestyle. Their question was simple. Why are we paying more tax than friends with similar spending? When we looked closer, most of their cash flow came from pre-tax IRA withdrawals and interest. Their friends were drawing spending from a brokerage account with long-term gains and qualified dividends, while using the standard deduction to wipe out small amounts of ordinary income. Same spending target, different character of income. We shifted their withdrawal order, harvested gains inside the 0% bracket, and set a plan for measured Roth conversions in years when Social Security and required distributions hadn't started yet. The goal wasn't cleverness. The goal was calm, predictable cash flow with a lower tax drag. If you want a simple way to apply this, use this 4-step framework once a year. Step 1, map your income buckets. List expected ordinary income for the year. Wages, pensions, IRA, 401k withdrawals, interest, non-qualified dividends, short-term gains, then list preferential income, long-term capital gains, and qualified dividends. Step 2, use deductions to clear the base. The standard or itemized deduction reduces ordinary income first. Know your filing status and current year thresholds. Ask how much ordinary income will remain after deductions. Step 3, fill the 0% and lower brackets on purpose. If the base is low after deductions, realize long-term capital gains up to the 0% threshold. If there's still room in lower ordinary brackets in early retirement years, consider measured Roth conversions to prepay tax at known rates while avoiding cliffs. Step 4, avoid the cliffs. Watch for things that change the math outside the tax tables. The 3.8% net investment income surtax at higher incomes, the phase-in of taxation on Social Security benefits, Medicare IRMA surcharges tied to modified adjusted gross income, and state taxes. You want clarity, not surprises. Why this matters in real life. It explains why early retirees often build taxable brokerage assets for flexibility. It explains why the order you pull from accounts matters. Brokerage first in some years, then IRAs, then Roth, sequence to preserve low brackets and minimize lifetime tax. It explains why two retirees with the same income can have very different tax bills. Let's tie it back to the original comparison. Person A's $60,000 came in as ordinary income that filled the base and triggered tax. Person B's $100,000 was largely long-term gains that sat above a cleared base and stayed inside the 0% bracket. Different character, different outcome. If you want to see exactly how this applies to your situation, I take on one new client a month. There's a link below where you can connect with me directly. We'll map your buckets, your deduction, your brackets, and your timing so you can see in black and white whether a few changes could lower your lifetime tax bill while keeping your plan steady. You worked hard to build your savings. You don't need to overspend on taxes out of habit. With a calm, once-a-year review of the order of operations, you can keep more of what you earn, fund the life that you want, and feel confident about the decisions you make.